What's up, everybody? Welcome to the Life Cycle of a Trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we are going to cover an iron condor. The market has been super weak over the last couple weeks here, hitting lows that we haven't seen since, the end of last year, really. One of the big things in this market right now is volatility. So if you look at the volatility futures, they're at 21 and change right now. You got the VIX itself at 23. Yesterday, we got into the 25, 26 handle, which is historically a very high mark for the VIX, and we actually looked at through the cherry picks, which you can subscribe to, tastylive.com/newsletters, free newsletter that we send out. Typically, when you get a VIX in the 25 handle, forward returns in 1 month increments are they tend to be slightly positive, about 0.5% or a little bit more than that, which doesn't mean I'm going to be jumping in to buy the dip here, but I think what we can do is look to take advantage of this very high implied volatility because it tends to not stick very much. So when you see volatility, you get these spikes in volatility, it tends to contract. Of course, the exact timing of the contraction is very hard to time, and it can stay bid for quite some time, but it is typically very quick in terms of when you see that volatility contraction. You can see it in these bars. You get that pop in volatility, pretty quick contraction there. So one of the ways that you can take advantage of that is just by going to the overall market itself, right? So I'm going to be looking at SPX. I'm going to do just a standard 45-day or around 45 days. We'll go to the 43-day weekly expiration. When you're trading SPX, there's two different types of expirations. So there's the standard monthly, which is the third Friday of the month. Every third Friday is going to be an AM settled expiration. So it actually settles to the settlement price, which is SET, in the morning of that Friday. So it's a little bit funky. The last day you can trade it is the Thursday prior to that AM settlement. So you can't trade it in the morning. It's based on all the opening prints of the S&P 500 stock. So, you have kind of binary risk of if there's a news event or something that bids stocks higher in the pre-market session, it can open SPX higher. On the other side, if there's something that happens, news event or whatever, and stocks are down, or really the big name stocks are down significantly, you could have what is called an underwater open for the SPX. So for me, I tend to go to the weekly expirations, which are PM settled, just like any other stock option. They settle to the closing print of SPX at 3 p.m. Central Time on that day. So I prefer to go to this weekly expiration, the April 17th, which is that third Friday, but in the PM, the afternoon settlement. So for this trade, we're just going to do a cookie cutter iron condor. We're going to go somewhere around a 20-ish delta on either side and do a 15-point wide spread here. So I'm going to look at, let's say, the 54.75. We'll go 15 points wide to the 54.60. So that'll give us a $2 and change credit. On the upside, we will do the same exercise here. We'll go to the 20-ish delta, let's say the 6,100. And we'll go 15 points wide and collect that extra $2 and change, $2.70 some odd cents. It's going to give us a credit of $5 and change. It's going to use about $1,000 in risk, which is typical for us in this, $5,000 to $10,000, kind of risk account. So this will be a short volatility play. It'll be a range-bound play. It'll take advantage of a slight up move if it comes with a volatility contraction. It'll give us, almost 300 points, 400 points in either direction here in terms of where our break-evens are. Just kind of a cookie-cutter way to take advantage of implied volatility when it's super high. So let's start high. We'll go to 575, and we can work our way down from there. Markets are moving, and they're moving pretty quickly, so you will see some swinging around in the prices here. Go to 570. Probably get filled somewhere around 550 would be my guess. About 1/3 the width of the strikes. There we go, 555. So, and the reason I know that is just because when you're selling around a 20 delta option and you go, 10, 15, 20 points wide, you're always collecting around 1/3 the width of the strikes. Here, we got filled at 555. We have a risk of $9.45 over the next 43 days. So, stick around. We've had a huge move to the downside, and thus the call spread that we have on, and look at this amount of scrolling I'm doing just to get there, has lost pretty much all of its value. You could see the position itself actually hasn't gone against us. It's basically a scratch right now, even though the short put spread is right at the money. And that's because of one, this call spread losing basically all of its value. So that's hedged us pretty significantly, as well as the pop in volatility that we've had. If you look at volatility futures, 23 and change, we're basically at the highs. This pop in volatility actually sort of helps spread trades because, and this is especially the case with spreads that are relatively tight, which is something that we have here with SPX, and that's because these options with the move in volatility move basically the same amount. And you can see it when we look at like a change. This one's a little off just because of some bad marks, but you can see all these options kind of move in the same magnitude because of the pop in volatility. It's a relatively tight spread. Both those options are very much similar from a risk perspective. So the put spread doesn't move all that much. Anyway, the adjustment we're going to make today is just to close out of this call spread. We're going to take off the risk on the upside. Not that I think we're going to have a 500 or 600 point up move in the next 37 days, but what this does give us the opportunity for is that if we do see a little bit of a pop to the upside and moved back, 100 points maybe to the upside or more, potentially, we could sell a call spread into that move. We won't be dragged. We won't have any of the drag that comes from this spread going from 65 cents to $1 or $1.10 or $1.20 maybe. So we're just going to leg out of this call spread here. We'll see if we get filled around 70 cents or so. There you go. 70 cents. So now we've got the short put spread on the 54.75, 54.60 short put spread for $4.85 credit that incorporates the cost that we just paid to close out of that call spread. So ideally, we see a little bit of a pop in the market to the upside, and a little bit of a contraction in volatility. Both those things would help us significantly. So we'll stick around. We'll see if we get that into the future. The interesting part about this adjustment, which I wanted to highlight because it's one of the things that benefits your positions into a move in your direction, but also because of the volatility. Volatility has come in significantly. So when we look at this position, when we originally put the trade on, we can go to the implied volatility index, the IV index, which is our 30-day VIX style implied volatility for the underlying. You could see that we started the position at 23.5-ish% implied volatility. When we bought back this call spread, vol was actually a lot higher, which means that call spread hasn't really moved in the 100 points or so upside move that we've had. You can see the implied volatility was 28.5%. It's now sitting at about 20%. So 8 vol points is a lot in SPX or SPY or E-minis. If you trade any of those, they all have very similar volatilities. But that's a lot of volatility that came out of that position, and that is why this spread hasn't really changed price. The 70 cents for the 6100, 6115, it hasn't really changed value, even though we've had about 125-ish point rally from where we sold it. We can even see it if we go to the activity. We'll flip over to SPX. We could do a similar order here just to show what that order is trading for right now. It's trading for exactly 70 cents, which is the same as what we closed it out for, but we closed it out when SPX was 125 points lower. So this spread, all else equal, if volatility had stayed the same, should be a lot higher priced than what it is right now, and that is volatility. That is, 8 points of volatility that came out of of that position. So it was a huge vol crush over that period of time. But with the vol crush and the little bit of a bounce that we saw, this spread is now marked at $2.90, maybe $3 here, depending on where we get filled. It's time to go. We're going to free up this capital. We're using about $1,200 in buying power on this position. It's about as good as it gets. A little bit less than 1/2 of the max profit here, but it's come in about, less than 2 weeks here. It's about as good as it gets. So we're going to route this order. We'll start at $2.95, see if we get filled here, and we'll probably have to walk it up to like $3.05 or $3 on the dot. There you go. Got filled at $3 debit. For a net $185 profit. Nice two-sided action here. Huge vol crush. That was really the biggest key to this position, is that volatility contracted, got a little bit of a bounce, which is what we needed from a directional standpoint, and ultimately closed out for a really nice winner.